Hey everyone, welcome back to Corporate Decoder. Today, Banc of California Inc. just filed its second quarter 2026 10Q, and I'm seeing a massive shift in their investments. Quick note, this is not financial advice, just my take on public filings for educational purposes. Banc of California reported a big loss this quarter, mainly due to selling off a lot of their investments to reposition their company for the future. Let's dive into Banc of California's financial picture for the second quarter of 2026. They've been making some pretty big moves. Looking at their balance sheet, the first thing that jumps out is how much their investment securities have changed. At the end of June 2026, they had zero in their held-to-maturity securities portfolio, which was worth over $2.3 billion at the end of 2025. They basically sold almost all of those investments. But they didn't just sell investments, they also bought new ones. Their available for sale securities jumped from $2.4 billion at the end of 2025 to $4.5 billion by June 2026. This is a huge increase, showing they're shifting their investment strategy. They also significantly increased their loans held for sale from $182.9 million to $915.2 million. This is part of a plan to sell off certain loans to reduce risk and improve their financial setup. Now, these big financial moves had a big impact on their income statement. For the second quarter of 2026, they reported a non-interest loss of $234.1 million. This is a massive swing from the $35.3 million in non-interest income they had in the first quarter of 2026. The main reason for this huge loss, a $256.7 million loss on selling their available for sale securities. This is a direct result of selling off those investments we talked about earlier, repositioning their company for potentially better future earnings. They also had a $12.5 million loss from loans they are planning to sell. All of this led to a net loss of $251.3 million for the second quarter, or a loss of $1.61 per S-share. This is a stark contrast to the $62 million in earnings they had in the first quarter and the $18.4 million in earnings from the same period last year. They are calling these strategic balance sheet actions to improve their long-term financial health. Another significant number here is the provision for credit losses, which jumped to $161.8 million in the second quarter from just $9.8 million in the first quarter. This increase is largely because of the loans they decided to sell, which had to be recorded at their lower market value, leading to higher charge-offs. Looking at credit quality, their classified loans and leases decreased significantly from $800.3 million at the end of 2025 to $582.8 million by June 2026. This is partly due to those loans being moved to the held-for-sale category, but it also suggests some improvement in the overall risk profile of their remaining loan portfolio. On the deposit side, things are looking more stable. Total deposits increased to $28.1 billion at the end of June 2026, up from $27.8 billion at the end of 2025. This shows they are still attracting and holding onto customer money, which is crucial for a bank. Their borrowings also went up, mainly from the Federal Home Loan Bank. This is common for banks to manage their liquidity needs. Despite the big loss this quarter, their capital ratios are still looking strong. Their Common Equity Tier 1 capital ratio was 9.25% at the 30th of June 2026, which is above the regulatory requirement to be considered well capitalized. Their efficiency ratio, which measures how much it costs them to generate revenue, was 67.18% in the second quarter. This means it cost them about 67 cents to make $1 of revenue. It is not the best, but it is not terrible either, and it went up from the first quarter, which makes sense given the big losses they took. Non-interest expenses, which are basically their operating costs, went up a bit to $189.9 million in the second quarter compared to $181.4 million in the first quarter. A big part of that increase was in insurance and assessments, likely due to those strategic balance sheet actions affecting their regulatory metrics. Interestingly, just after this filing on the 7th of August, they announced they're paying out dividends on both their common and preferred stock. This shows a level of confidence from management despite the current losses. Now, what does this all mean? Banc of California is making some bold moves to clean up its balance sheet and reposition itself for potentially better long-term earnings. They sold off a lot of lower-yielding investments and are actively selling off some loans. This strategy caused a big hit to their earnings in the short term, but the goal is to be more profitable and less risky in the future. The risk I am watching is whether these strategic moves will truly pay off in the long run, and if they can continue to attract deposits in a competitive market. What I am actually looking for is how these new investments perform, and if they can manage their credit risk effectively through the ongoing economic uncertainty. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps. And subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.